My generation was supposed to be the most educated, most connected, most informed generation in human history. And somehow we're on track to be the first generation in modern Western history to die with less money than our parents. Not because we're lazy, not because we drink too much coffee. The math just genuinely does not work the same way anymore. The guy who graduated in 1988, got a decent job, bought a house at 24, and retired with a pension, he wasn't smarter than you. He wasn't more disciplined. He just stepped onto a different machine. And that machine carried him upward with almost no resistance. You stepped onto the same machine, except yours is going down. And here's the question nobody actually wants to answer. If the machine is the problem, why is everyone still blaming the passengers? Here's what we're going to do. We're going to explain exactly how this machine works, why it used to go up, what broke it, and why it's getting weird in ways that most financial content refuses to talk about. Not to depress you. Not to inspire you either, because I don't do inspiration. I do mechanics, and once you understand the mechanics, you can at least stop making it worse. The central metaphor I want to use is an escalator. Specifically an escalator that used to go up and now goes down. And I want you to hold that image in your head for the entire video, because I'm going to keep coming back to it. The escalator is the economic system, not your boss, not the government specifically. The whole interlocking structure of housing, wages, debt, assets, and time. When the escalator goes up, even bad decisions look smart. When the escalator goes down, even good decisions feel pointless. And the tragedy of Gen Z is that most of us are still running the playbook designed for an up escalator while standing on a down one. Let's start with the foundation. And I mean the literal foundation. Housing. In 1970, the median home in America cost roughly 2.5 times the median annual household income. So if a family earned $12,000 a year, the median house was around $30,000. That ratio, price to income, sat somewhere between 2 and 3 for most of the post-war era. It was uncomfortable, but manageable. You saved for a few years, you got a mortgage, the payment was painful but survivable. Fast forward to 2025. The median home in America costs roughly 7 to 8 times the median household income. In cities like Los Angeles, San Francisco, or New York, you're looking at 12 to 15 times. Maybe more. Same escalator. Different speed. And instead of going up, you're now trying to step onto a moving walkway that is actively pulling you backward while you carry $150,000 in student debt. Now, before someone says just move to a cheaper city, look, I hear you, and that's actually solid advice for some people. We'll get to that, but the point right now isn't the solution. The point is understanding what actually changed and why the common explanation, you guys spend too much money on brunch, is so spectacularly wrong that it borders on deliberate misdirection. Here's the actual math, and I want you to sit with this for a second. If you earn $60,000 a year, which is around the median individual income for someone in their late 20s right now, and you save 10% of your take-home pay, you're putting away roughly $450 a month. In 3 years, you've saved about $16,000. In 5 years, roughly $27,000. A down payment on the median American home today requires around $60,000 to $80,000 minimum. And that home, while you were saving, appreciated somewhere between 5 and 10% per year. So the goalpost moved faster than you could run toward it. You didn't fail. The geometry of the problem made failure the default outcome. The escalator wasn't just rising for your parents, it was rising faster than anyone saving their way to the bottom rung could compensate for. And this is where the first deep misunderstanding lives. People think the problem is affordability, like it's a cash flow problem. It's not. It's a structural timing problem. The asset class that previous generations used to build wealth, real estate, has decoupled from the wages that the next generation earns. Those two things used to move together loosely. Now they don't. And when you decouple asset prices from wage growth, you don't just make buying harder, you make wealth transfer between classes almost impossible unless you already own the assets. Think about what that actually means. If your parents own property, they're gaining $200,000, $300,000, $400,000 in net worth without doing anything, simply because the asset inflated. If you rent, you gain nothing from that inflation. You actually lose because your rent goes up. So two people working the same job, same salary, same city, one is getting silently richer via an asset they inherited or bought 20 years ago, and the other is running on a treadmill. Same effort, completely different outcomes, not because of discipline or intelligence, because of what they own. This is not a motivation problem. this is a structural problem. And the system is not broken. It's working exactly as designed. It just wasn't designed with you in mind. Let me give you the second layer, because the housing story is the one everyone already kind of knows. The less talked about one is what I call the wage compression trap. From roughly 1945 to 1973, wages in America grew in near perfect lockstep with productivity. If workers produced more, they earned more. The relationship was almost mechanically reliable. After 1973, and this is one of the most important economic facts of the last century, productivity continued climbing. Wages didn't. They flatlined in real terms for the bottom 80% of earners, meaning the gains from productivity went somewhere. They went to capital, to shareholders, to people who owned things rather than people who did things. Now, here's why this matters specifically for Gen Z and not just as a general observation. Every previous generation that got squeezed at the wage level still had access to cheap assets to compensate. If you couldn't earn your way to wealth, you could buy a house in 1982, hold it for 30 years, and get rich anyway. The asset side of the equation patched the wage side. You didn't need to understand any of this, you just needed to participate in normal life. Gen Z doesn't have that patch. Wages are still compressed, but now the assets are expensive too. The last backdoor to the middle class just got bricked over. And what replaced it? A system of debt-financed consumption that creates the aesthetic of a good life without building any of its substance. Let's talk about debt for a minute, because this is the part that actually makes me a little tired. The student loan system in America, and to varying degrees in the UK, Canada, and Australia, is one of the most elegant wealth extraction machines ever built. I say that genuinely, not sarcastically. Elegant in the engineering sense. You convince 18-year-olds who legally cannot rent a car, who have no real understanding of compounding interest, who have been told their entire lives that education is the ticket to success. You convince them to sign a contract for $100, $150, sometimes $200,000. You make the debt nearly impossible to discharge in bankruptcy. You attach it to their income, and then you tell them good luck. The average Gen Z college graduate enters the workforce with around $37,000 in student debt. Sounds manageable until you realize that at 6% interest, that debt is accruing roughly $2,200 per year just in interest, before they've paid a single dollar of principal. And if they're on an income-based repayment plan, which many are, they might not even be covering the interest. The balance is literally growing while they're making payments. The escalator going down while they walk up. And here's the brutal second-order effect nobody explains. Student debt doesn't just cost money. It costs time and optionality. Someone with no debt at 23 can take risks, they can start something, fail, try again. They can move to a different city for an opportunity, they can say no to a bad job. Someone with $40,000 in debt at 23 can't say no to anything. They're effectively already employed by their lender. Every career decision gets filtered through the question of whether they can make the payment this month. And that constraint, invisible, financial, permanent, shapes every downstream decision they make for the next decade. The debt isn't just expensive, it's a behavioral modifier. It makes people cautious exactly when they should be bold. Now, I want to throw in something that might reframe the whole thing, because I think most people, when they talk about Gen Z and wealth, they're only looking at the income and expense side. They're missing the asset side entirely. Here's a number that should bother you. In 2023, the wealthiest 10% of Americans held about 70% of all stock market wealth. The bottom 50% held roughly 2%. Gen Z, as a cohort, owns an almost negligible share of financial assets. Boomers, who are retiring right now, control a massive chunk. And here's what that means in practice. When the stock market goes up, which it generally does over long periods, boomers get richer in their sleep. When Gen Z works, they produce value, take home a paycheck, and then spend it on rent that enriches a landlord who is probably also a boomer. I'm not saying this is class warfare. I genuinely don't think most boomers sat around plotting this. I'm saying this as a systems observation. When you look at who owns the productive assets of the economy, and who provides the labor, and how the returns are distributed, you get a very clear picture of which direction the escalator is moving for different groups. This is actually a good moment to introduce something I think about a lot. There are essentially two kinds of income. I call them flow income and stock income. Flow income is your salary, your hourly wage, your freelance invoice. It comes in, you spend some, you try to save some, and then you need it again next month. It flows through you. Stock income is the income you earn from things you own. Dividends, rent, appreciation, equity. It doesn't require your time. It compounds, it grows while you sleep. The entire post-war middle-class playbook was secretly built on converting flow income into stock income through homeownership. Buy a house with a fixed mortgage, let it appreciate for 30 years, retire with an asset worth many times what you paid. Simple, reliable, almost automatic. The problem is that the entry point into that conversion, the house, is now priced at a level where the conversion math no longer works cleanly. You'd have to overextend so aggressively to buy in most markets that the mortgage payment consumes the cash flow you'd need to invest in anything else. So Gen Z is stuck in flow income, working, earning, spending, repeat, with no automatic escalator into stock income. And the gap between people who have stock income and people who don't is compounding every single year. If you're still watching, this is probably the kind of content you want more of. Systems, mechanics, real numbers. Not motivation, not vibes. If that's you, subscribe. Because this is exactly what I keep making here, and I'd rather have a smaller audience that's actually thinking about this stuff than a big one that just wants to feel inspired. Let me bring in a concrete scenario. Not a personal story, but a model. Let me walk you through two people. I'll call them Marcus and Ethan. Same age, 24, same city. Similar income, $62,000 a year each. Marcus graduated without debt. His parents, not wealthy, but homeowners, refinanced during a low interest rate environment and helped him cover community college, then a state school. He graduates clean. He lives at home for 2 years and saves aggressively, putting away roughly $1,800 a month. By 26, he has $43,000 saved. He buys a small condo with an FHA loan, 3.5% down on a $220,000 property. His mortgage is around $1,300 a month. His net worth is starting to build. Ethan graduated with $52,000 in student loans at 6.5% interest. He cannot live at home. His rent is $1,400 a month. After taxes, loan payments, rent, and basic living costs, he saves around $200 a month. At 26, he has roughly $5,000 saved. He cannot qualify for a mortgage. He keeps renting. His loan balance has barely moved because the first 2 years of payments were mostly interest. Same income, same starting age, same city. At age 35, Marcus has roughly $140,000 in home equity, whatever appreciation the property gained, plus 10 years of investing whatever he saved after his mortgage. Ethan has maybe $30,000 in retirement accounts if he's been contributing to a 401k and is still carrying $30,000 in remaining loan balance. That's a gap of over $150,000 in net worth between two people who worked the same job for the same decade. Not because one was smarter or worked harder, because one started on a debt that functionally prevented wealth accumulation for the entire decade. The escalator for Ethan didn't just slow down. It put him on a treadmill and called it a career. Now, I want to shift gears slightly because I've been talking mostly about structural economics, and I want to get into something that doesn't get enough credit. The psychological dimension. Because the structural problems are real, but there's a behavioral layer on top of them that makes everything worse. And Gen Z, I say this with no judgment because I'm in this generation, has been systematically trained to make the behavioral choices that accelerate financial decline. Here's the thing. Social media, and specifically the attention economy, has done something to consumption patterns that I think will only become visible in the data over the next 10 to 20 years. It has compressed the timeline of identity signaling through purchases. In previous generations, you bought status slowly. You saved for the car, you waited to furnish the apartment. Status came later, and it was attached to actual accumulation. Now, status is immediate. A 23-year-old with a credit card and an Instagram account can perform the aesthetic of wealth in real time. The vacation, the outfit, the restaurant, the apartment staging. None of it requires wealth. All of it requires spending. And the platforms are specifically optimized to maximize the frequency of these status spending moments, because each one is a microtransaction in the attention economy. Your consumption is content, your lifestyle is inventory. The result is a generation that, at scale, spends at a velocity that would have seemed insane to any previous cohort. Not because they're stupid or vain, because the incentive structure of the platforms they use rewards this behavior constantly and punishes the alternative, which is quietly saving money. which generates nothing for the algorithm. I want to be precise here. I'm not saying stop spending money on things you enjoy. That's not my angle. My angle is understand what you're optimizing for. If you're optimizing for the appearance of a good life at 24, the math eventually catches up with you. The platform doesn't care about that. The platform got its engagement metric. Here's a short story that illustrates this. A guy I observed, not someone I know personally, but a pattern I've seen play out. Let's call him Tyler. Tyler earns $58,000 a year at a marketing firm. He lives in a nice apartment, around $1,500 a month. He dresses well, he goes out, he has a really good camera, he posts consistently, his followers think he's doing great. Tyler, however, has no savings. He has $4,000 on a credit card at 22% APR. He has no emergency fund. His retirement account has been opened but never actually funded beyond the initial deposit. Tyler is performing financial stability while structurally being one unexpected expense away from a real problem. And the truly dark part? Tyler is not unusual. He is median. The average American under 35 carries roughly $4,000 to $5,000 in credit card debt, has less than 1 month of expenses in liquid savings, and has either no retirement account or a negligible balance. Tyler is the expected outcome of the system, not the exception. Credit card interest at 22% on $4,000 is around $73 a month just in interest. That's not principal. That's money that disappears. $1,100 a year leaving his hands and arriving in the hands of a financial institution that lobbied to make sure the rules work exactly this way. I'm going to say something slightly uncomfortable here. The financial system is not indifferent to Gen Z struggling. There are specific industries that profit enormously from financial instability among young people. High-interest consumer credit, payday lenders, buy now, pay later services that have exploded specifically because they're psychologically engineered to feel like nothing costs money until it does. Rent-to-own furniture, the entire subprime auto market, each of these is a business. Each of these businesses has a specific customer profile, and that profile is someone who needs cash flow now, has no assets as collateral, and will pay a premium for immediate consumption. That profile describes tens of millions of Gen Z adults. And these businesses are growing. The escalator going down generates revenue for people selling rides in the other direction, at high interest. Now I want to get into what I think is the deepest and most counterintuitive part of this whole conversation. And this one genuinely surprised me when I first started thinking about it clearly. Everyone talks about income as the solution. Earn more, problem solved. And to be fair, earning more helps, obviously. But income by itself without assets or ownership does almost nothing to close the generational wealth gap, because the gap isn't primarily an income gap, it's an asset gap. And those two things compound at completely different rates. Here's a concrete illustration. Imagine two people, one earns $60,000 and owns a $200,000 house. One earns $90,000 and rents. Over a 10-year period in which home values rise at 5% annually, the homeowner's asset grows to approximately $326,000 without doing anything. That's roughly $126,000 in gains from doing nothing other than continuing to exist in the property. The higher earner, if they save and invest well at a 6% return, might accumulate somewhere around $100,000 to $120,000 after taxes and living costs. The person who earned less and owned an asset potentially comes out ahead or equal purely because of the asset. Now you might think, okay, that's fine. That just means Gen Z needs to buy assets sooner. And yes it does, but here's the problem with that framing. The entire system of advice, content, education, and financial literacy aimed at Gen Z focuses on behavior change. Spend less, budget better. Stop buying coffee. When the actual leverage point is structural, get into an asset-owning position as fast as possible. Even imperfectly, even small, even aggressively. A small ETF portfolio started at 22 will do more for your financial future than a decade of extreme budgeting without investment. The machine rewards ownership, not frugality, but you know what's funny? Almost no one teaches you this. School doesn't. Parents who don't own financial assets can't. And the content that reaches Gen Z algorithmically is mostly either doom posting about how impossible everything is, or luxury lifestyle content that performs wealth without building it. The middle, actual asset acquisition strategy for people starting with almost nothing, barely exists in mainstream financial discourse. It exists in corners, in specific communities. in places you have to seek out. It's not hidden, it's just not promoted, because there's no obvious business model for teaching people to slowly, methodically build wealth. There's a great business model for selling them things. To be fair, some of this is shifting. The rise of retail investing, index funds becoming mainstream, the fact that you can now open a brokerage account and buy a fraction of a stock for $5, these are genuinely meaningful changes. The on-ramp to ownership is technically lower than it's ever been, but access is not the constraint anymore. The constraint is cash flow. If you have $400 a month in rent, $200 in loan payments, $200 in food, and $100 in transportation, and your take-home is $1,200, you have no cash flow to invest. The machine is accessible. The ticket is just expensive when you're already behind. Let me take a second to be very precise about something because I think a lot of commentary on this topic makes a mistake that I want to avoid. The claim is not that Gen Z can't build wealth. Some of you watching this will build serious wealth. I'm trying to. I'm grinding toward it. Some of you already have. The claim is that at a generational cohort level, the structural conditions have shifted in ways that will produce significantly worse median wealth outcomes for this generation compared to every modern predecessor. The average Gen Z person following the standard life script, college, entry job, rent, slow savings, will retire with less real purchasing power than the average boomer who followed their version of the standard life script. That's the statistical expectation. You individually can deviate from it, but only if you understand why the default is broken. Now let's talk about the third escalator dynamic, and this one is probably the most abstract, but bear with me because I think it's the one that has the most actionable implications. Inflation. Not inflation the way people talk about it in the news. Egg prices, gas prices, asset price inflation, because these two inflations have been running at completely different rates for the last 30 years, and they produce opposite effects depending on what you own. Consumer price inflation, the kind the Federal Reserve tracks with the Consumer Price Index, has averaged roughly 2 to 3% per year since the 90s. Mild. Manageable, annoying, but not catastrophic. Asset price inflation, housing, stocks, private equity, art collectibles, has run significantly higher in many periods. The stock market has averaged roughly 7 to 10% annually in real returns. Housing in many metros has appreciated at 5 to 8% annually. So if you own assets, your wealth inflates. If you own no assets and earn a wage, your wage rises at roughly the consumer inflation rate, maybe less, and all the things you want to buy, a house, a stock portfolio, financial security, have gotten more expensive faster than your wages. This is the core mechanic of the machine. This is why the escalator goes down. Wages are indexed to one inflation rate. Assets appreciate at a higher one. Every year you don't own assets, the gap between you and the asset owning class widens automatically. Not because they work harder, because their assets are indexed to the faster inflation. And here's the cruel math. If you earn $55,000 and invest nothing for 5 years while a diversified stock portfolio returns an average of 8% annually, a person who invested $50,000 5 years ago now has around $73,000 without doing anything. Their money grew by $23,000 while yours stayed at zero. That $23,000 gap doesn't close when you finally start investing. It compounds ahead of you. You're not catching up. You're running a race where the finish line is a moving target that moves faster the longer you wait. The escalator goes down. Time is not neutral. Every year of delay in getting into an ownership position has a non-linear cost. This is also why I'm deeply skeptical of the just enjoy your 20s financial advice. Not because your 20s shouldn't be enjoyable, they should be. I enjoy mine. But the framing that your 20s are a consequence-free financial period and you can figure it out later is demonstrably wrong when you do the math. The compounding clock doesn't care about your enjoyment. Starting at 22 versus starting at 32 isn't a 10-year difference. It's roughly a double difference in terminal wealth if you're compounding at 8%. The person who started at 22 and invested consistently will have roughly twice what the person who started at 32 has, assuming same contributions and same rate. That's not a small gap. That's the difference between a comfortable retirement and a stressful one. Let me now talk about what I think is the most painful escalation of all of this. The one that ties everything together. It's the retirement system, the defined benefit pension, which most boomers either had access to or were adjacent to, is dead for Gen Z. Done. It was systematically replaced by the defined contribution system, which is the 401k. And the 401k is a great tool, I use one. But it transferred a specific risk from the employer to the employee. Before, the company or the government promised you a specific income in retirement regardless of what markets did. Now you own the market risk. If markets perform well, great. If they crash the year before you retire, like they partially did in 2008, well, that's your problem now. The boomer who retired in 2004 with a pension got their check regardless of what the Nasdaq did. The Gen Z worker who retires in 2055 with a 401k needs markets to cooperate and needs to have consistently contributed for 30 years, and needs to not have rated it during a job loss, and needs to have started early enough for compounding to do its job, and needs healthcare, which is a whole separate brutal conversation. To be fair, if you do all of that correctly, the 401k system can work. It's not a bad tool, but it requires a level of financial discipline, market literacy, and long-term stability that the boomer generation was simply not asked to maintain. They had a simpler machine. Ours is more complicated, and the downside of getting it wrong is entirely ours to absorb. And then there's Social Security, which I'll just say briefly. The current projections suggest that by somewhere around 2033 to 2035, the Social Security Trust Fund runs into significant funding issues that will likely result in either reduced benefits or increased taxes or some politically painful combination of both. Gen Z workers are paying into a system right now that may pay them less than what the current schedule promises. I'm not saying it disappears. I'm saying it's not the backstop it was for our grandparents. The machine has fewer safety features on the floor below you. Look, I know this is getting heavy. Here's a short comedic break, because I need one. Imagine trying to explain the current housing market to a boomer who bought his house in 1979. So you're saying you just don't buy a house? I can't afford one. Well, just save up the down payment. I've been saving for 4 years. I have $18,000 saved. And in that time, the house I was looking at went up $90,000. Well, have you tried cutting back on avocado toast? Sir, the avocado toast costs $14. The house went up $90,000. I would have to never eat again for approximately 17 years to make that math work. Please sit down. End comedic break. Back to the machine. I want to give you something useful now, not motivational, not a list of platitudes. Actual structural reframes for navigating a down escalator. The first thing, and this is the insight that changed how I thought about money, is that the goal is not to earn more. The goal is to own something that earns for you. Income without assets is a treadmill. It feels like progress and produces none. Every dollar you earn should be evaluated against one question. Can any portion of this dollar be converted into something that will produce future dollars without requiring more of my time? That's stock income. That's the escalator. When you have stock income, you're on the machine going up. When you don't, you're fighting gravity every month. The second thing, the system rewards early imperfect action over late. Perfect action. This one took me a while to actually internalize. There's a psychological trap, I see it constantly, where people wait until they've paid off all their debt, until they have enough money to invest properly, until they understand everything before they start. This is rational sounding, but structurally catastrophic. The compounding clock runs while you wait. Starting with $200 a month at 23 is better than starting with $500 at 32. The math is unambiguous on this. Don't wait for the perfect entry point. The cost of waiting is more expensive than the cost of starting imperfectly. Second comedic cutaway, I'm going to start investing once I've paid off all my debt and built a 6-month emergency fund and taken that online course about options trading and rebalanced my budget spreadsheet. Bro, you're going to be 50. Actually, though, paralysis by optimization is a real phenomenon and it is expensive. The guy who opened an index fund with $300 in 2018 and forgot about it has done better than the guy who spent 6 years researching the perfect portfolio and hasn't bought anything yet. Okay, third reframe. Location arbitrage is the single most underrated lever available to Gen Z right now. And I say this as someone who thinks about this a lot. The structural problem, assets too expensive relative to wages, is not uniform. It is violently non-uniform. There are cities, regions, and countries where the price-to-income ratio is still manageable, where you can actually buy an asset on a normal salary. The people who will build wealth in this generation are largely going to be people who either inherited assets, worked in high-income tech or finance roles, or made deliberate geographic decisions to get their cost structure into alignment with their income. Living in San Francisco on $60,000 and complaining that you can't save money is a real problem, but it's also partly a choice. The escalator goes down slower in some places than others. Positioning yourself in those places is not selling out. It's systems thinking. Now let me close the loop on the original question. Why will Gen Z be the first generation to die poorer than their parents? Not because they're lazy, not because they make bad individual decisions, though some do, because 4 structural shifts happen simultaneously that no single generation had to deal with in combination before. 1. Asset price inflation outpaced wage growth, eliminating the passive wealth accumulation mechanism that the middle class relied on. 2. Student debt entered the system at scale, creating a preloaded financial handicap that delays asset acquisition by a decade for a significant portion of the generation. 3. The pension system was replaced by a system that transfers market risk to individuals who are not equipped, informed, or stable enough to manage it effectively across 30 years. 4. The attention economy created a behavioral environment optimized for consumption and status spending that works directly against the accumulation behavior required to overcome points 1, 2, and 3. These are not random bad luck. They are the predictable output of specific policy decisions, business model innovations, and institutional shifts that happened over decades. The machine was redesigned and then handed to a generation that was still reading the old manual. But here's the thing, and this is the part I want you to sit with. Understanding the machine is not the same as being trapped by it. I'm not sitting here making doom content. I'm trying to show you exactly how the gears work so that you can find the ones that still go up. Because there are escalators going up. They're just narrower. They require you to be more deliberate, more patient, and more structurally aware than the generation before you. The guy who wins in this environment is not the one who works hardest. It's the one who owns something, starts early, positions geographically intelligently, and keeps his cost structure low enough to generate cash flow that can be converted into stock income. It's the one who understands that the system is not going to reward his effort automatically, so he designs his life so the system has to pay him anyway. Here's what I want you to actually take away from this. 3 things. Not generic, mechanically specific. First, calculate your asset to debt ratio today. Not your income, not your expenses. Your assets divided by your liabilities. If that number is below 1, meaning you owe more than you own, you are structurally moving backward regardless of how much you earn. The first financial objective is not to earn more. It is to get that ratio above 1. Then start converting surplus cash flow into ownership positions, index funds, property, anything that compounds as aggressively as your cash flow permits. Second, treat time as a compounding asset and behave accordingly. Every month you delay getting into the market or into an asset position has a specific calculable cost, not abstract future cost. Actual cost. If you're 24 and you invest $250 a month into a broad market index fund at a 7% average annual return, at 65 you'd have approximately $725,000. If you wait until 34 to start the same contributions, you'd have roughly $375,000. That gap, $350,000, is the exact cost of the 10 years you waited. Know your number, it changes behavior. Third, stop optimizing your income and start optimizing your ownership percentage. This is the mental shift that separates people who get wealthy from people who stay in flow income. Ask yourself, of every dollar I earn, what percentage converts into something I own? If the answer is 0, your income is completely irrelevant to your long-term wealth. If the answer is even 5%, you've started, get that percentage up. Not your salary, your ownership percentage. The escalator goes down. That's the reality. You cannot vote it upward with productivity. You cannot budget it upward with discipline. You cannot wish it upward with positive thinking. But you can find the specific mechanisms within the system that still ascend, get onto them early, and let compounding do what it does. That's not motivation. That's math. And the people who understand this in their 20s will be the ones who look back at this generation and say, the machine was broken, yes, but I didn't need the machine. I built my own. If this made you think, subscribe. I put out this kind of content regularly, and I'm not going anywhere.